Alright, welcome to Unit 4, first video. I'm actually quite excited. This is the home stretch and we're almost done. So, let's start off. This video and the next few videos are going to concern balance day adjustments. Before I go into the individual topics and today's video topic, I'm actually going to talk about what is balance day adjustments. So, balance day adjustments are adjustments made obviously on balance day, that ensure our reports are 100% accurate. So those are those little things that go in memos, like your depreciation or your inventory counts. So why do we do them? Firstly, it's ensure we meet the accrual assumption that our revenues that we earn are matched against the expenses incurred for those same periods, and therefore we can accurately calculate profit. It also ensures that we're faithfully representing the reality we operate in. We are also providing relevant information that can help us with decision making. So those are the big ones there. So balance day adjustments, what can they be? What do they look like? Firstly, it is going to be inventory gain, inventory loss, and inventory write-down. We have already done those in Unit 3. Now they can also be prepaid and accrued expenses, which is what today's video is. And then after that, it's going to be depreciation, selling non-current assets, looking at things like bad debt and unearned revenue. Those are all items that can be considered balance day adjustments. Now, how will you know those? They'll be at the end of a question, like on the screen. So, there'll be those dot points in the additional information. You just need to keep an eye on them, normally denoted by a memo. So, what we're going to do is we're going to start off with prepaid expenses. We're then going to move on to accrued expenses, and we're just going to show different treatments of them, how we record them initially, and when we pay them off, all those lovely things. So the whole life cycle of both. Now, let's bring up, firstly, I want to just recap how we record expenses. So on the screen now, you have a rent expense paid on the 30th of April. And you see here, debit rent expense 2,000, GST clearing debit 200, and bank credit 2,200. We're used to that, we know that, but you're not going to be paying your rent month by month. You might pay in 6 monthly allotments. You might pay 3 months ahead and pay it every 6 months. So there's got those variables there. Very much what we're doing now does reflect the real world. Think about it when we pay wages weekly. Obviously, the month is not going to end on a payday. Like that just is impossible because of the way the calendar is. So this does reflect reality. So we're going to go through some examples. So the first example we're going to bring up is on the 10th of May, we paid $6,600 plus GST for rent covering the months of June through to August. So that's when we're going to use the rent, in June, July, August. That's a 3-month period. But we paid it on May the 10th. So we've paid for this expense, but we're not using it yet. That is a prepaid expense. So a prepaid expense is an expense you pay for in advance. It's going to be future economic benefit in terms of that expense. You're going to use it. And it's a result of a past transaction. And we're going to use it within 12 months. So all prepaid expenses are current assets. We're going to talk about that at the end. But let's record this transaction first. So, very similar to recording a basic expense, but instead of rent expense being debited, it's going to be prepaid rent expense, debit 6,000, GST clearing 600, also a debit, and bank 6,600 with the narration at the bottom. Narrations are important. Please do not forget them. People have a habit of forgetting them, and that's like a free mark on the exam. So If it tells you to put it on there, please put it on there. And the impact on the accounting equation is that it increases the prepaid rent asset, goes up 6,000. The decrease of 6,600 on the bank leads to a net decrease of 600. Meanwhile, on the liabilities, it's a decrease of GST clearing. That liability goes down. Also 600, but no effect on the owner's equity because the expense has not been incurred yet. That's important. And here you've got the general ledgers. You can see here with prepaid rent expense, we've put that straight in along with GST clearing and the bank as well. And we see debits and credits both totaling 6,600. So everything's fine. We've got our current asset. It now gets to the end of June. We've used 1 month of the 3. So that's 2,000 per month, by the way. So the following month, end of June, we need to deduct the rent that we have used for the prepaid rent expense, memo 001. So we see 30th of June. This time we debit the rent expense, 2,000, and we credit the asset it's held in, the prepaid rent expense. That's a credit, also 2,000. And we can see the narration here, paid rent for the next 3 months, totaling 6,000 plus. Oh, that narration should be, I read the wrong one on my notes, intelligent. It should be used rent for 1 month worth $2,000, memo 001. So we can see there, going through the rent, we have now expensed it. And the impact on the accounting equation is we decrease the prepaid rent by 2,000, no effect on the liabilities, and on the owner's equity, we decrease profit via the rent expense, so profit will go down because it's an expense of $2,000. And then we've got the general ledgers. This time we can see the prepaid rent, we balance it off at the end of the period. There's still 4,000 left. The rent expense, the 2,000 is on the debit, and if we want to close it, it will be the P&L summary, like we would close a normal expense. So there's no bank here, there's no GST, and that's important because we only deal with GST at the point of transaction. I'm going to say that a few times this video. Next, we have accrued expenses. So the accrued expenses are different, as these are expenses we have used that we now need to pay back. That paying back is an obligation. And this time, that obligation will mean it's a current liability because we plan to pay them back within a year. So accrued expenses, always current liability. So in this one, on the 31st of July, we used $3,000 worth of advertising, and we plan to pay it back, or it's to be paid in or during August. Memo X2. So we look at our general journal. We put in 31st of July, advertising expense 3,000, and the accrued advertising a credit of 3,000. So that creates the liability account. And this narration will have incurred advertising expense for July, memo X2. And very much it becomes the expense, and we ensure that we are following the accrual assumption. So the impact on the accounting equation, there is no change on assets. We increase the accrued advertising by 3,000, that liability. We then decrease profit as advertising expense by 3,000. So essentially it becomes 0 in the assets equals 3,000 minus 3,000, because liability has gone up 3,000, owner's equity also down 3,000, balances out to 0. And in the general ledger, we can see very much advertising expense, accrued advertising expense 3,000, and this is how it would look if you closed it, the P&L summary again on that credit side. And the accrued advertising expense liability, 31st of July, advertising expense on the credit side, And then on the debit side, when we close it off, we'll balance it just to ensure that we carry forward a credit balance for the following month. Now, next transaction, the following month, we pay it off. So on the 8th of August, the advertising used last month is paid off, check 501. Now we bring up the general journal, we see date 8th of August, and you've got the accrued advertising expense, a debit of 3,000, so that cancels out the liability, so liability balance is 0. The GST clearing of 300, making sure we're paying GST, and the bank 3,300. So, and that's a credit because bank going down. And the narration paid advertising worth 3,000 plus GST that was used the previous month. Check 501. So, we have a look here. We notice the GST. So, again, GST is always used at the point of cash transaction or when it's paid off. And then the impact on the accounting equation, we see the asset decreasing bank by 3,000. We decrease accrued advertising expense by 3,000 as well. So bank is 3,300. And the decrease the GST clearing by 300. And there's no effect on owner's equity because profit's not touched. We used the expense or incurred the expense the previous month. So you can see 3,300 down, and that is demonstrated in the liabilities. And then if we have a look at our general ledger, we can see August 1 balance 3,000, and then the bank, because we've paid it off on the debit side, also 3,000, and that means it's a balance of 0. You got the GST clearing debit 300, and then the bank, you can see on the credit side 3,300. So that's a nice simple way. So if we're going to carry any balances forward, just remember prepaid expense goes on the current asset, accrued expenses goes on the current liabilities. This is important to remember. Make sure we get those right because accrued we do owe. So I just really want to reiterate here. These occur over multi-month periods. You will be required to get a per month. So you need to read the question closely. Like making sure we understand what is the question actually asking and then be able to calculate from there. If you can get something down to a per month basis, I think you're in a better spot. GST is always done at the point of transaction, not when the expense is incurred, when the cash is paid. So GST always at point of cash. And lastly, I know this is going to suck because there's no like pearls of wisdom here. It's literally practice makes perfect. That's all I can say, guys. So please, please, please remember that. So what next? I would say any transaction or how I would tackle these type of questions. I would add any transaction into the pre-adjusted trial balance. So you get your pre-adjusted trial balance at the start. You are then going to add it into that and make a post-adjusted trial balance. Using that post-adjusted trial balance, we're going to create our reports. And from that, we're going to close our revenues. We're going to close the expenses, close P&L summary, close drawings, and then balance assets, liabilities, and owner's equity. So it's just making sure we follow that. So before you were only given a pre-adjusted trial balance. Now, this point of the year, you should be starting to work towards a post-adjusted trial balance. And the only difference is you've done your balance day adjustments. That's the only difference between those two reports. So, any questions, please leave them in the comments. I wish you the best of luck. Good luck for Unit 4, and I will see you next time. Later.